Hello traders, in this video we're going to go over my latest swing trade with SPXL. That's an S&P 500 ETF. So it is leveraged 3 times. If the S&P goes up 1%, SPXL goes up 3%. Likewise, if the S&P goes down 1%, SPXL goes down 3%. So just to give you kind of the broad view of things, the trade was entered on October 19th. I'll show you the exact time and date and price entry and exit in just a moment, but basically we got in over here and we got stopped out over here for a profit, and I'll go over the amount of profit and all that kind of stuff and why I got in there, why I got out. So let me just show you really quickly the orders and then we'll get back to the chart. So this here was a day trade, so ignore that. That has nothing to do with the swing trading plan. It was just also on SPXL. That was yesterday, but we got stopped out of the trade on December 1st, and we entered that trade on October 18th. So that's right here. So you can see here we entered with 5 shares at 119.74, and that quantity, that's based off of previous swing trades with SPXL. So I calculate the quantity based on how much I'm willing to risk, and that risk also comes from the wins of previous trades. So I don't want to say give back all my wins of the previous trade. So I never risk more than about 50% of my previous wins on these SPXL swing trades. So that's the trade right there, in at 119.74 on October 18th and then out at 125. It hit our stop here at 3:23 p.m. On December 1st. So the difference between those two numbers times the number of shares, that's our profit, and I can show you that on my spreadsheet. So here's the trade. It's the 5th trade we've taken with SPXL since we've been swing trading it with Webull, and our first trade was on May 20th. And let's see, the entry price, the ideal entry was 119.71, got filled at 119.74, not bad at all. Here was our initial stop. So our initial risk was almost $13, and that is based off of, say, like our average winner. If you go through the P&L of the previous trades, one of them is a little bit tricky to figure out here, but it's, so the trade number 3, sorry about this, trade number 3 is the sum of these 3 right here. So let's see, about $29, right? And then the other 2 trades were about $20. So we'll just, for easy math, we'll say the average winner is around $25. So that's where that risk comes from. I don't want to risk more than about half of my previous wins on a single trade. And this one here, trade number 4, that was a loser. And I did write a note about that trade. The entry was a little bit unorthodox, and I've made a note in the plan not to take entries like that in the future. Let's be clear, it's not because that trade didn't work out. It's because the trade was kind of outside of the plan a bit. It was kind of something I was trying to see if it would work out, and I was only trading with 2 shares, keeping the risk down to my normal desired risk level. But yeah, it was just not something that I would normally do, so I made it a point not to take trades like that in the future. And again, that doesn't mean that all the trades that I take in the future are guaranteed to win. Of course, there could be losers, and that doesn't mean I'm going to change the plan because of that, but that was just an entirely different entry than what I normally take. So because it was below the 50 MA, that's about it there. And the interesting thing is, even though I'm trading with small position size, relative, I guess, it's all relative, small position size on these swing trades, and the P&L looks small. It's only $86 and change since May. The numbers are really encouraging when you look at it from a perspective of risk, or I should say return on investment. So here's a nice little summary right here. Let me zoom in so it's easier to read. So first trade was on May 20th, and as of December 3rd, we've taken 5 trades with an average of $488 used per each trade. So the total profit after those 5 trades is about $87. So our return on investment based on that average price that we're using on each trade is about 17.7%. And that's over a 6-month period. So theoretically, if you were able to continue that over a year, you might be up about 35. So let's say 30 to 35%. And those are very encouraging numbers, especially when you consider that trading the S&P 500 is a lot less risky. It's a lot more predictable than individual stocks. And what would the alternative be to investing in something like this? Maybe a CD or a money market or something like that in the bank, and you'd be lucky to get 2% a year right now. So if you're doing 30% per year, that's a huge, that's 15 times, 15 times, maybe 30 times, because now a lot of interest rates are 1% or even less. So, it's a huge difference compared to what you can get in the bank with the same amount and you really can't invest. You can't, the bank won't give you interest on this amount of money. So it really is something interesting. And I'm glad that I've been doing it and seeing what the potential is. And when I'm investing with more money, I will definitely consider continuing this strategy. Of course, I will keep you updated on all of that stuff as it happens. So let's go back to the chart. I want to share one more thing with you, kind of a concept. Let's see here, single chart. So I've gotten the question a few times, why don't you sell at the highs or something like that? First of all, we never know when the highs are going to be. And sometimes people will say, well, you can see obvious signs of weakness. So just for example, taking this last trade that we took, we entered right here on this candle. And if you're following these daily candles as they appear, and you see, okay, this thing is breaking out over previous highs, which was 126.09. So it's breaking out over previous highs. That could be a sign that it's going into a point of resistance. And then you see two red candles, and then you're thinking, oh, well, this is definitely weak here, so let me get out here. Well, look what ends up happening. So that's why the plan that I trade is written around the 50 MA line. Just with S&P 500 ETFs, I do not use these indicators in my normal day trades, but I've studied the S&P 500 quite a lot, and I've noticed this trend that keeps occurring. So, and that doesn't mean it's going to continue to do that, but that's what this plan is based on. And you can see what ends up happening. This thing stays up above the 50 MA for a long time, and that's where I was moving my stop. Again, my entry was back here. I'm moving my stop up along the 50 MA. It takes a while to become profitable during the individual trade, but eventually it happened, and then we get stopped out over here, and there's no telling that this was going to happen again. This is the first sign that things could reverse, especially on this candle here, but they didn't. They continued higher, and then this was the sign of another pullback, but they continued higher again, and then finally pulled back down here. There was no telling that this was going to be the moment that we get stopped out. Sometimes it comes down very near the 50 MA and then reverses and goes higher. So I'm totally happy with just following the 50 MA and getting out of the trade when I see a sign of weakness like this. Now, normally after it stops me out on the 50 MA, I'd be looking for my next entry. But this trade is a little bit different because these candles are massive. If you go back over the chart, so let me zoom out a little bit. The candles are going to get a little smaller, but again, keep in mind, just relate them to the other candles that we're looking at. So check out the size of these candles versus the size of all of these candles. And even as I zoom out further and we go back in time on the chart, I'm going to make all the candles smaller. But again, it's all about relative size. So I'm trying to keep these on the chart. So just look how massive these candles are versus all these previous candles. And we can actually use the grid. So this candle here is stretching about 1.5 grid length. So I'm looking at these little white boxes here. So about 1.5 boxes. And as we scroll back, that way we can kind of keep that in mind. We don't see any more candles that are reaching, ranging through 1.5 of those little boxes. So the closest thing is back here during the pandemic. Those boxes that's not really a great thing, because this candle, it looks like it's about 1.5 boxes, which it is, but this one is an even larger range. But this was right after the pandemic hit, so you kind of expect that there. So the whole point I'm making is that the plan was written around entering after much smaller candles, on the order of 2.5 to 5%. And here we're seeing candles of 5% to 10%. right here. So anyway, that's just a little FYI. I don't want to influence any other traders onto, like entries that you're going to take. So if I ignored the range of the candles and just traded based on my, excuse me, my plan as it is written, I could have entered right here and my stop loss would have been right here and I would have been stopped out today. But again, using my plan criteria and how I calculate position size, I would have only been able to take a 1 share position. Otherwise, I would have been giving way more back than 50% of my previous wins. So yes, I would have been stopped out here, but it would have been a loss of about $12 or $13. So anyway, even if I would have just kind of blindly followed the plan and ignored the unusual nature of these candles relative to the ones that this plan is based on, I still would have been okay. But this just gave me a little bit of pause for the cause, because these candles are way larger than all of the candles that we normally see on the S&P 500. So take that, for however you want to interpret that to, or, whatever you want to interpret that to mean. I don't want to influence anybody on how they trade. The main thing that I want to get across in all of my videos is that you need to have a plan going into every single trade, whether it be one of my plans or a plan you based off of the way that I trade or some plan that you've come up on your own. The most important thing is that you have a plan. And then the next most important thing is that you follow that plan. That plan is absolutely worthless if you don't follow it. And then if you're not tracking those trades, you're not going to know if the plan works out. So you got to be tracking your trades. Then even with these swing trades, you see I have stop losses in place. The profit target thing is a little bit different with these swing trades, but with my day trades, I always have a profit target out, and I always take that profit target when it gets hit. I always take my stop losses when they get hit, and I always recommend that you do the same. So as always, go into every single trade with a plan, stick to that plan no matter what, always take your stop losses, honor your profit target, and in the long run, you should be green. Take care.